Today we're digging into one of the most powerful and hands-on ways to invest in real estate, direct ownership. I'm Kenji, one of the founders of Semi-Retired MD, and I spent nearly a decade teaching high-income professionals how to confidently buy their first rental property, scale their portfolios, and take control of their financial future.
And I'm Josh. Today we're breaking down how direct ownership scores using our fast-fire investability scale, so you can decide if it fits your portfolio and goals.
When we say direct ownership, we mean you own the property, whether it's a long-term rental, a short-term Airbnb, or a mid-term rental for traveling nurses. You hold title, you control operations, and you keep the profits.
But either way, you're going to be much more actively involved in the investment compared to investing in a REIT or a real estate syndication.
Let's walk through how direct ownership scores on the three-part investability scale. Let's start with return potential. When done right, direct ownership has incredible upside. You can use leverage, force appreciation, and optimize cash flow. Many of our students see double-digit returns. We're giving it an A because of the combination of equity growth, income, and tax benefits that can significantly outperform the market.
Next up is risk profile. Real estate carries risk. Market cycles, vacancy, repairs, but it's a tangible asset and not as volatile as stocks. You can control a lot of the risk with education, systems, and great team members. That's why we rated a B.
And finally, accessibility. It does take capital to get started. You might need $25,000 to $100,000 for a down payment, closing costs, and reserves. And there's a learning curve. You don't want to invest that kind of money if you don't know what you're doing. This is a time-intensive investment at first, especially your first property. So we're going to give it a C in accessibility.
Okay, to sum it all up, here's how direct ownership scores. Return is an A, risk is a B, accessibility is a C.
Let me give you a few quick examples of what this looks like. A doctor who's in fellowship training buys a duplex near the hospital, house hacks by living in one side and renting out the other, which allows them to live rent-free and build equity. Next is a couple. One is a lawyer and the other is an engineer with a combined annual salary of $400,000. They go out and acquire a short-term rental in a popular vacation area. The property cash flows about $75,000 per year and at the same time shelters half of their W-2 income. And the last example is a doctor and her husband buy 10 long-term rental units. The property's cash flow about $100,000 per year, and at the same time, with the husband claiming real estate professional status, he is able to shelter $150,000 of his wife's income.
These are real strategies we see high-income earners use all the time to start their wealth-building journey.
Direct ownership is ideal if you want control of your asset, big tax savings, especially with real estate professional status or the short-term rental tax loophole, and to build equity while earning income. If you're a high-income professional looking to replace your W-2 income, direct ownership is one of the fastest, most effective ways to do it. If this sounds like something you'd like to explore further, go to semiretiredmd.com/newsletter for more information and free resources.
But direct ownership is not for everyone. If you want hands-off investing, you might prefer syndications.
All right, well that wraps up our investability score for direct ownership. Now don't forget to like this video and subscribe to our channel. See you next time.